Here's the problem. You're at least 60 years old, and you've got a life insurance policy that you don't need anymore, or can no longer afford. It could be any type of policy, and it could be personal or business insurance. But if you let the policy lapse, you either lose all the money you've paid into it, or settle for what the insurance company will give you back for it. So what's the alternative? Sell your policy to a third party, an institutional buyer, like a bank or investment company, for as much as 20 to 40% of the death benefit. It's called a life settlement, and it can pay you much more than what the insurance company will pay you. According to an article in the Wall Street Journal titled Life Insurance for Sale in a Secondary Market, the idea, which is gaining in popularity among older policyholders, is to raise cash now rather than wait until death. You see, a life insurance policy is a capital asset, like real estate, stocks, bonds, or any other investment, which means that it has market value and can be legally transferred to any third party willing to pay you for it. And you can use the money any way you choose, to provide retirement income, or to pay off your mortgage, for medical expenses or long-term care, for a grandchild's education, or a charitable donation, or simply to replace your current policy with one that doesn't require any more payments. And if your business owns the policy, you can use the money to pay down a line of credit, to purchase new equipment, to pay yourself a retirement bonus, or replace the policy with coverage on another executive. For example, consider the 75-year-old man who wanted to donate his $1 million policy to a local charity. The charity would keep making the annual payments and receive the death benefit upon the man's passing. And the man would take a tax deduction for the policy's cash value of $220,000. But he was offered $539,000 by an institutional buyer, more than twice what the insurance company would have paid. So the charity received the cash immediately, was not burdened with any payment obligations, and the donor was able to write off an additional $319,000. Another example involved several policies totaling $10 million, owned by a corporation on its executive shareholders, with a cash surrender value of $800,000. But the company was being sold, and the executives would be leaving. So the company put the policies out to bid, and received a settlement offer of $3.5 million, $2.7 million more than what the insurance company would have paid them, which it then used to fund a deferred compensation plan for the new management team. And a life settlement can be processed in as little as 4 to 8 weeks. It begins with a short application, a copy of your policy, and a copy of your medical records, which are then submitted to several institutional investors who will bid on the value of your policy. And if you accept an offer, the settlement funds will be deposited into an escrow account, and the insurance company will be notified of the change in ownership when the change is verified. The settlement funds will be transferred directly into your bank account. That's really all there is to it. And when the transaction is complete, the company who buys your policy will become the new owner and pay all future premiums, and will collect the death benefit when you pass on. The money you receive up to your cost basis is tax-free, and your profit, the money you receive over your cost basis, may be subject only to capital gains tax.